Welcome to part 2 of Introduction to Financial Statements. On part 1, we introduced the 4 major financial statements and talked mainly about the balance sheet and income statement. We decided to create our own ice cream business on 1/1/15, and by the end of 1/31/15, we business transactions that had only affected the balance sheet. Just as a refresher, we raised some capital through debt and equity by us giving $30,000 of equity and loaning $20,000 from our mom. And then we purchased inventory and a truck. And the truck we purchased with accounts payable from our truck vendor, which we told them we'd pay them in 6 months. None of the transactions affected the income statement. They were all balance sheet transactions. So now what I'd like to do is this the right one? Let's look at our business in the month of February. So our income statement is going to start new. It had 0 transactions on it in the first month, and for this month we're going to have 1/31/15 to. Oh, actually, you know what? Take that back. I'll erase the whole thing. Month of February does not start in January. We will have 2/1/15 through, I don't think this is a leap year, 2/28/15. Short month, tough month for revenue. And on balance sheet, we'll have a new balance sheet here with 2/28/15. So we have 3 balance sheets. Balance sheet number 1, there's nothing in it. Second balance sheet we worked on in our last video. In this video we'll work on this 3rd balance sheet. So let's get started. So let's say in our 2nd month of business, we're trying to generate revenue and sell some ice cream here. So let's sell some ice cream. Let's say we generate $60,000 worth of revenue in the month of February. Pretty good ice cream sales month. Must have been hot. And that means our cash goes from 25 to 85. Let's say we charge cash, so everyone has to pay us up front before they get their ice cream. Now, associated with this revenue, there was a cost of goods sold. This line item here, cost of goods sold or cost of our sales, is a direct cost associated with the revenue. And that usually comes in the form of our inventory. Let's say to generate the $60,000 in sales, we only had to use 5,000 of our inventory. So inventory now goes down because we've given it to our customers. 5,000, and our inventory goes from 25 to 20, and we expense out 5,000. We have expensed out our cost. You see this? This is a very important relationship. We had 25, now we have 20, and the 20 on the balance sheet goes, the 25 goes to 20 by expensing out 5,000 on the income statement. So what does that mean? Now our gross margin on the income statement is 55,000. Gross margin is just the revenue minus the cost of the goods sold. Now, also in this month, we didn't just sell this 60,000 without any other expenses. We had other indirect expenses like the gas for the truck. We were selling with the truck. What is that? Gas? That's expensive, although it's a good time to buy gas right now. Let's say the gas, which is an operating expense, is, I don't know, 7,000 for the month. Let's say we also had payroll. We had to pay some people. Let's say that was 3,000. Just make my numbers here a little even. And let's say, what else is an expense that we could have? Let's say, I don't know, rent for our warehouse. We had to pay some rent on our refrigerator to keep the ice cream cold when the truck wasn't running. Let's say that was 4,000. So that's a total operating expenses of 14,000. So what does that mean? Well, we had to pay for this, or we had to either pay for this or get credit terms for these operating expenses. So let's say we asked our vendors, all these vendors, hey, can we pay for these expenses in 6 months? So they say sure. So we have accounts payable that was at 15,000, that was paying for our truck. Now it's going to be at what's that, 29,000? 29, 15 plus the additional 14 of accounts payable that will pay out in 6 months. Our truck is still 15,000. Our debt is still 20,000 at the end of the month. We haven't paid anything back yet. Our truck's still 15. So now, over back on our income statement, we take our gross margin and you subtract the operating expenses to get your profit. And let's see what that is. That is 41,000. So our profit for the month was 41,000. Pretty profitable month. We're pretty psyched about that. So now let's add up our assets, liabilities, and equity. Our assets was at 90, 120. 120,000 in assets, pretty good. Our liabilities and equity add up to, this is still 30,000. 79,000. Yikes. So we're off. And what are we off by here? Well, we happen to be off by the exact amount of the profit number. So we're going to add in the statement of retained earnings to show you how these two statements are connected through this profit number. And we talked about in the earlier segment of the first video about how equity is made up of either retained earnings or contributed capital. The retained earnings is just reinvested profit. So the profit of this $41,000, let's just say we reinvest all of it. What does that mean? Well, we don't give any to our owners. We just put it right back into our business. So that would be keeping this retained earnings, 41,000. We could have paid it out to our owners, who is ourselves. So I could have given myself 41,000, but I decided to put it back in the business. Now we have 120,000 of liabilities and equity. And just show you roughly what that looks like on a statement of retained earnings. I made a little statement here. And the statement of retained earnings just says, hey, what was our retained earnings at the beginning of the year? Beginning of the time period of 0. We didn't have any retained earnings. What was our profit? 41,000. What were our dividends? Oops, it's supposed to be a D there. We paid out 0 because we didn't want to give any money to our owners. So what is our retained earnings at the end of the period? Which I guess is not 331, which is actually 228. Sorry, 15 is 41,000. This 41,000 is then brought, the 41,000 as you can see goes here and then goes up to here. That's how all three of the documents are connected. So hopefully the financial statements are starting to make more sense. The last thing I want to cover is how do we get the numbers on the financial statements? Where does the 25 come from? Where does the 85 come from? You don't just write that in, do you? Well, I'm sure you've heard of a journal entry at this point in class, or maybe you have. And if you have, a journal entry is the tool used to get these numbers on the financial statements. The journal entry, general ledger, trial balance process, which we'll go into in future videos. So don't worry about that. Just make sure you watch those videos. And then in the next question you might be asking is, how would I have known to capitalize inventory and truck? I didn't, I don't know that. And the rest of the numbers that we put on here. Well, the rest of your textbook and the majority of the rest of these videos will be around specific accounting rules and regulations, to teach you where inventory goes, where cost of goods sold comes from, where gas comes from, where debt comes from. So just make sure you watch the rest of those videos, and you should know how to get the numbers on here and why certain numbers go to certain accounts.